Folks, do you understand the missing piece to this commercial real estate crash? I believe there's only one missing piece, and we are actually starting to see it. I believe the office building at 300 or 350, excuse me, 350 California Street in San Francisco is the start of the missing piece. We will get into that in a minute, but first let's welcome Jonathan Twomley to the show. How you doing, buddy?
I'm doing great, Michael. How are you today?
I'm doing well, man. So over the last month or so, maybe 2 months, you've been gracious enough to remind us that buyers and sellers really aren't meeting eye to eye. Somebody wants yesterday, somebody else wants tomorrow. Transactions down 75, 80%. It is really a frozen market. Then we hear on the side about this Houston blow up. We hear about this, we hear about that. And what I really think the missing piece in the commercial market is what I call price discovery. And that is where a transaction occurs. And 350 California Street in San Francisco was rumored to go up to an 80% discount. We talked about it on my channel about a month ago. It appears to have actually transacted at a 73% discount. So if you want an office building in downtown San Francisco in on or near market in the financial district, you now know that the price point is 73% below what it was. Obviously, this building is 75% vacant, has other issues, I'm sure, but price discovery is coming. And I think this could be meaningful going forward. What do you think?
Yeah, I mean, the markets are funny, right? They kind of like need transactions to do transactions, right? Everybody's always looking at the last transaction to see what they need to pay for something or what they should be paying, for something. And if there's no transactions in the market, then people are afraid to venture forth because they don't want to overpay, right? And so you can have a situation where they look at an asset and they say, boy, it's 50% off the peak, but are we down 75%? I don't know. I don't want to overpay by 25%. So transactions need to start happening for people to know where the market is. And it almost doesn't really matter like where the transactions end up. They just need to be happening so that other people feel confident that they know what they're paying for an asset is something approaching its market value, right? But when you don't know when there are no transactions happening, you don't know what the market value is because the market value is the sum total of all the transactions in the market, right? So that's what's going on right now. That's why you have these kind of freezes in the market when you have a sudden shock to the system, like interest rates rising or like a liquidity crisis or whatever it is. When people just stop doing transactions, then yeah, it can just grind to a halt because nobody knows what to do.
Yeah, and I think price discovery actually really has two important elements. One is probably what most people go to is, hey, if I'm a buyer, I now know where, the last transaction was. I actually think the issue with price discovery is far greater than that because there are likely banks with loans on similar office buildings in San Francisco who have a mark significantly higher than 73% off. And now if there's a transaction and they are forced to mark to market, that could hurt their asset values, right, on their balance sheet. But also, I think more importantly, I think this gives their credit department or loan department or whatever probably more reasons to extend and pretend. It's like, we're not taking that haircut. We're going to give that operator another year. We're going to survive to 25 because that market is too deep. What do you think?
Yeah, well, the thing is, like, if the problem is you have like a collective action problem there, though, right? Like everybody could do, unless everybody's doing it, they can't stop the market from resetting, right? Now, maybe it's true that every individual bank has got like it is going to be thinking the same way that like, hey, if we mark this down, that is affecting the value of our whole portfolio, right? So that maybe they all have an incentive to act the same way. But at some point, you do get cases where they just they have no choice, right?
Sure.
Like if an operator walks away and hands them the keys,
Agreed.
right? They have no choice but to move forward with that transaction because they don't want to operate the building. They don't know how. They don't, it's not
Well,
part
it's
of their
not there.
business.
Yeah.
So,
Yeah.
but yeah, I mean, that could be part of it. But I think I think if there starts to be volume in the business, right, the banks obviously will have to mark down their portfolios to market value, but they'll be generating new loans at new basis with new, that.
Well,
So
well,
it'll,
let's talk about that because I think that's what we hope for.
yeah,
But I think marks like this will actually prevent new loans, right? I think that's really what we're seeing going forward. And the other thing that I am really afraid of, and we talked about this 6 months ago, you validated at your event, is some of these marks could be so bad and the banks need cash. And they're like, hey, I can't get cash from that person.
yes.
I'm going to go get cash from that person. And that operator never missed a payment, never had an issue, fine LTV, but they have to refi somewhere else, or heaven forbid, if everybody's doors shut, they become a forced seller by
Yeah.
circumstance. That could be really interesting.
Well, I guess the saving grace of the multifamily market though is a if you're over $1 million, if your loan is over $1 million, then you can go to Fannie and Freddie. And
Okay.
Fannie and Freddie, as was mentioned at my conference, are because of the 75% decline in volume, they're 75% unallocated. They have a
Right.
lot of money to work with, right? So you may be seeing Fannie and Freddie picking up the slack in those cases. Now, recently Fannie and Freddie has had the opposite problem where they couldn't compete because they required higher DSCRs, and the terms weren't quite as good as some of like the bridge lenders were offering and whatnot. So Fannie and Freddie actually got crowded out of the market because people couldn't compete with a Fannie and Freddie loan. So they were going for variable rate bridge debt, which gave them a few more basis points. Now Fannie and Freddie's got money to spend, but they don't have any deals, right? So I think that you may see them stepping in if we start to see this happening where people can't refinance from local banks, that maybe Fannie and Freddie are going to come in and pick up that
Okay.
slack. But you still may wind up with the situation where people have to do cash in refis. That doesn't alleviate these other
Yeah.
issues necessarily, but it does at least mean that somebody will be lending, I believe. So at
But
least
yeah,
on,
get ready for that term cash in refi. I think that's going to be the term of 2024, cash in refi.
yeah, I
Yeah.
think there's definitely some of it coming. But like I said, as Jay Parsons argues, the number of these is going to be, like, compared to the entire volume of the market, the number of these is going to be small. But I guess then the thing you have to consider too is, well, there's like relative to what? Like relative to the size of the entire market or relative to what's being transacted, right? So
Right.
if a very high proportion of deals that are being transacted are
Are these?
are
Yeah.
these deals that can't be refinanced, well then then you have the recipe for a rapid change in cap rates, right?
Yeah,
So
and that's what I see coming is again, if you're a good operator with a solid asset and you have timelines and you are planning to exit in 23 or 24, you'll just wait. It's like
right,
this is not the time. You have the time. But if for some reason you just get caught and your bank says no, and you don't have the capital for I don't know, an extra 10% cash in, you can become a forced seller. You can become, and if you're forced to sell in an environment where transactions are down and lending is tough, you're gonna feel that.
I think the people who are really going to be at risk here are kind of like the weaker operators
Of
who
course.
didn't execute on their value add, right? Who didn't create the additional NOI that they needed to get them above that cushion, right?
Mhm.
So yeah, I think a lot of people are going to wind up not getting the proceeds that they hope for, but they're still going to be able to refinance their deals. They're just
Yep.
not going to be refinancing them at the level, where they're returning capital to their investors and stuff. But they're not calling for cash either, so everyone's going to be happy. Um,
Yeah.
their debt service is going to go up though, which will not make anybody happy. But at least they're not doing capital calls, right? But I think the real issue is for those operators who bought at the top, couldn't execute a plan,
Yeah.
and were just essentially hoping that they were just going to continue this whole flipping game, you know, turn 10 units and flip it in 18 months as another
Yeah.
value add for the next fool, right? So those
Yeah.
those guys are all going to crash and burn. And that's what that Houston deal was, right? I
Oh,
mean,
yeah, absolutely.
yeah,
Yeah. Yeah. So I actually wanted to talk about capital calls because if I think back to kind of 21 and 22 on a scale of 1 to 100, there was like one or two capital calls, right? It was very uncommon to have a capital call. If we go to 2023 or 2024, I think capital calls are going to go up, maybe more than you. It wouldn't shock me 25% of deals, so 1 in 4 have a capital cost sometime in the next 18 months. How does that feel? Am I too negative, or
Well, you're talking about for a refi or for
no,
operations or
just for just basically, hey, we want to build our cushion, or a rate cap is too expensive. I don't care what
well,
the excuse is, but
I
1 in 4 deals are going to have a capital
I
cost.
think
I think.
rate caps. I mean, I can't really speculate onto the number, but the rate caps are really where I think it's going to happen, right? Because the even though there's been some softness in some rental markets, by and large, the rental market is still very strong.
Mhm.
There's still a supply issue. There's a few markets that have been overbuilt and they're having some issues, but even in those markets, that's Class A that's having the problem, right?
Right.
It's all the Class
All
A
the
compared
new stuff.
to other
Yeah.
Class A. If you're a little further down on the food chain, you're not going to be as impacted by this. So you're probably okay from an operation standpoint. The issue is really, and I'll actually make a couple of exceptions to this in a moment though. The issue is really going to be where people have rate caps that they now need to refinance, and maybe they bought the rate cap for $35,000, and now it's going to cost them $1 million to buy a new rate cap, right? And they've got to come up with that cash somehow, and the only way to do it is, most of the prudent operators have cut off distributions. They're squirreling away cash in advance of this to try to reduce the amount of money that they're going to have to ask, their investors for. But I think there's going to be definitely some of this where investors are going to be asked to pony up just to pay a rate cap, which is, completely waste of money. I mean, it's necessary to save your investment, but it is just such a foolish thing to be spending money on. And, if people had to buy rate caps in the first place, in my mind, they shouldn't have been doing the deals, right? But, that's where we found ourselves 12 months ago. So,
Yep. So you had a couple exceptions you wanted to
yeah.
say?
So the couple of so the other thing that we're seeing, we haven't actually talked about this before, but in a couple of the darling states for multifamily investors, namely Florida and Texas, you're seeing some other phenomenon, which is the incredible rise of insurance rates
Oh, I heard about this. Yeah.
and property taxes, right? So in those states that have I actually have a good friend who's a really good real estate investor, happens to be also a very conservative guy. And guess what? He only invests in states that have income taxes. Why
Ah,
is it?
because
Because,
yeah, you got to get the taxes from
got
somewhere.
to get taxes from somewhere, and he'd rather that they're getting their taxes from the people who live there rather than from him through property taxes, right? So
Ah, there you go.
and these states that have no income taxes, they've got to get it through property tax. And they, with the run up in prices, right? They haven't changed the way they tax, which means that the taxes
Oh
have
yeah.
right on these valuations. And
Yeah.
unless they go and cut property taxes or cut the property tax rates dramatically, which is always it's a double-edged sword, because then what happens when property taxes fall? You've just created another problem
Yep.
for you. So
Yep.
they're probably reluctant to cut the property taxes, but they're getting, so the combination of the two, with insurance rates going up anywhere between 40 and 100%, and then taxes going up as well, you're taking a huge hit on NOI,
Yeah.
which then
Oh
turns around
yeah.
and drops your value a lot. So it's there, a lot of people were still very high on those markets because of the demographic changes going on. But you kind of got to wonder, like, can they sustain the rent growth necessary to offset those kinds of, because those are basically your single biggest cost after debt service
Mhm.
is property tax,
Yeah.
right? And then
Yeah,
and
it's
then
crazy. I mean, that you've just highlighted why Olivia and I passed on Texas, right? So back in 2006, we had 8 homes. We thought California homes were overvalued. We did a road show. We went to Texas, Vegas, Colorado, looking for the next market, and we didn't go to Texas because of property taxes. Like
hmm,
they reset every year. We were investors, so we would get hit, and Yeah, I'm seeing a lot of comments. There's a lot of people that did Airbnb and this other things that were just anybody. This is what drives me crazy about investors. When this easy money button comes up, whether
Yeah.
it be LPs or GPs and this stupid bridge debt that we've talked about, but also Airbnbs are easy, print money. I had people making fun of me being a landlord month to month, making 250 or $300 a month. I'm making $1,000 as a short term rental. I'm like, well, let's see how long that lasts. Bingo bango, taxes go up. Now they're negative $1,000. And oh, by the way, occupancy's down and room rates are down. And I'm like, well, tried to warn you, So yeah,
Yeah.
it's crazy.
Investors are like that, right? They're always
Of
chasing
course.
the
That's why I can watch them and run the other way.
I mean, the thing you have to watch out for really is always as an investor is people in general, right? Not just investors. Human beings are lazy. It's like
Yeah.
and I'm not saying that in a pejorative way. Like we're evolutionarily lazy in order to save energy, right? Because thinking is the thing that consumes the most energy. So we're programmed to not think, which sounds crazy, right? And so people just want to do the easy thing. And if they see someone making money, they just go follow it, uh, and then they want to make themselves feel better about what they're doing because they know that they're being lazy and haven't thought about it. They criticize anybody who says, "Hey, watch out! Maybe you shouldn't be doing this." And just that's why we have a market. That's why we have
Yeah.
market cycles because of this,
Exactly.
right? So
Exactly. Well, we're going to break apart into video number 3, talk about what people should be doing to get ready. Because again, I think you can make significant moves in a recession and a bad time. It is, I don't know, it is certainly harder than the good times, scarier, but a lot more rewarding. But before we do, Jonathan, how can people find you?
yeah, so there's lots of ways to get in touch with me. But if, for instance, you'd like to join my investor list, I mean, we actually do have an active deal right now in a pretty smoking hotel that I located. You can come to Two Bridges Asset Management. So just Google us, and there's an investor form that you can fill out on the website, and you'll get added to our investor list. And if you would like to just join the conversation about multifamily and hotels and whatever else, come to my Facebook group at Apartment Investors Club on Facebook, and we'll chat there.
Awesome. Thank you, buddy.